If you're earning under $75,000 a year and someone tells you to just invest in index funds and wait 20 years, that advice is tailored for those who don't live paycheck to paycheck. Here's the harsh reality. When you're struggling to build an emergency fund and every month feels like a financial tightrope walk, being told to lock away money for 2 decades isn't just impractical, it's tone deaf. Today, I'm going to challenge everything you've been told about investing and show you why the single best investment you can make isn't in the stock market, gold, or cryptocurrency. It's in something much closer to home, yourself. So, let's address the elephant in the room. Traditional financial advice preaches the gospel of compound interest. Save $500 a month, earn 7% annually, and in 30 years, you'd be a millionaire. Mathematically, it makes sense. Psychologically, for someone making 45 grand a year, it's torture. When you're earning under $75,000, every dollar has a purpose today. You're not just planning for retirement, you're budgeting for next month's rent, unexpected car repairs, and perhaps, just perhaps, a small vacation that doesn't break the bank. The promise of wealth in 2046 doesn't help you sleep better in 2026. This is where the mental game becomes crucial. Humans are wired for immediate feedback. When you invest $1,000 in the S&P 500, you might see it grow to $1,070 after a year, if you're lucky. But when you invest $1,000 in yourself, the returns can become apparent within weeks, sometimes days. Jim Rohn said it best. If you want to have an above-average salary, you need to become an above-average person. Let's consider 2 examples. Mark worked in appliance sales, earning about $38,000 annually. He invested $149 in a high-level sales training program. Within 2 months, his closing rate improved by 40%, and his annual income jumped to $67,000. The course paid for itself in the first month. Jessica was stuck in a $41,000 administrative role. She scraped together $500 for a Google digital marketing certification and supplementary courses. 6 months later, she transitioned into a digital marketing coordinator role at $58,000, with a clear path to earning over $75,000 within 2 years. As you can see, a simple investment in a secondary course can open your career path in unexpected ways. With the recent AI boom, many processes have become automated, resulting in job losses for numerous individuals. However, while AI has displaced some jobs, it has also created new opportunities. I firmly believe that in the near future, the most profitable jobs will be related to AI, such as AI prompters, professionals who know exactly which keywords to use to achieve desired results. Currently, the cost per AI search is very low. However, I anticipate that in the future, the cost of these searches could increase significantly, potentially tenfold or more. This makes it crucial to have specialists who understand how to craft effective prompts for AI, ensuring that searches are optimized and money is not wasted on inefficient queries. But your focus doesn't have to be solely digital. Some of the best side hustles today involve becoming a handyman. While many people aspire to be influencers or create the next Facebook, this has led to a significant shortage of plumbers and electricians, making these trades quite lucrative. Now, I'm not suggesting you pursue a plumbing certification, as that requires years of experience. However, you can learn other skills, such as barbering, auto detailing, or general handyman tasks like installing TVs or fixing outlets. Learning a new skill that could potentially earn you money starting next month not only offers financial benefits, but also provides mental relief. Let's be honest, if you're struggling paycheck to paycheck, your biggest worry is how to make it to the end of the month. This mental burden is exhausting and creates a lot of stress, preventing you from focusing on wealth creation as you remain in survival mode. Having a skill that could provide for your immediate needs serves as an important anchor, alleviating some stress and enabling you to think more clearly and find more opportunities to earn additional income. When you're making under $75,000, motivation can be fragile. You need to see progress to maintain momentum. This isn't a character flaw, It's human by nature, amplified by financial stress. The traditional investment mindset often requires delayed gratification, a luxury that many people in lower income brackets simply cannot afford psychologically. When you're constantly worried about money, the abstract promise of future wealth feels less tangible than the concrete skills that could improve your situation next month. But what about risk? Skeptics ask. What if the course doesn't work? Here's the beauty of investing in yourself. Even failed educational investments leave you with more than you started with. A stock can become worthless, and gold can lose value, but knowledge and skills, they're permanent additions to your arsenal. Moreover, the risk profile is completely different. When you invest $1,000 in stocks, you risk losing that entire amount. However, when you invest $1,000 in a skill, the worst case scenario is that you acquire a new skill that might not pay off immediately, but you still possess that skill. Here's what financial advisors often overlook about compound interest. Confidence compounds too. Every skill you master, every course you complete, and every small win you achieve builds psychological capital. When you're earning under 75k, this psychological compound interest can be more valuable than financial compound interest. Confidence leads to better job interviews, a willingness to negotiate your salary, the courage to start a side business, the ability to take calculated risks. These intangible returns can generate more wealth than traditional investments ever could. Now, I'm not saying that investing is bad. I would never claim that, as investing is one of the most effective paths to financial success. Instead, I advocate for a strategy that enhances both your return on investment and your peace of mind. Consider this example. Let's assume you manage to save $200 a month. Over the course of a year, that amounts to annual savings of $2,400. If you decide to invest this amount in an ETF with 10% annual return, your profit for the year would be $240, with a monthly profit of around $20. While this may seem like a safe way to grow your savings, the reality is that the return on investment is relatively modest, especially for those living paycheck to paycheck. Now let's consider the alternative of investing that same $2,400 into personal development, such as taking courses or learning new skills. While the return on investment in traditional stocks is predictable but limited, the ROI from self-investment can be significantly higher, particularly regarding income potential and job advancement. Imagine you invest your $2,400 in a marketing degree or a professional certification. If this investment leads to a new job or a promotion, the income increase could be substantial. For instance, new job salary increase. Suppose you land a job that pays $10,000 more annually than your previous job. This translates to a $10,000 profit for that year, or about $833 per month. Even if the course only leads to a modest raise, the potential returns are often far greater than the $240 you would earn from traditional investments over the same period. Let's also examine how traditional investing performs when you have a more substantial amount saved. If someone has $24,000 saved and invests it in an ETF at the same 10% return, the profit would be $2,400, with a monthly profit of $200. This demonstrates how larger accounts can yield significantly greater returns. However, for those earning under $75,000, reaching that level of savings can be challenging, making the incremental gains from traditional investments less impactful. The stock market will experience downturns, gold will fluctuate, and cryptocurrency, well, who knows what will happen there. But with your skills, your knowledge, and your increased earning potential, these assets appreciate consistently because they are tied to human value creation, not market speculation. So if you're making under $75,000 a year, you don't need to wait 20 years to see your investments pay off. You don't need to check portfolio apps and stress about market volatility. You need to invest in the one asset that works with you every day: yourself.